we're inching really close to that Bank of Canada rate cut. It's going to happen either in June or July, depending on how the Stats Canada's CPI inflation numbers come in on May 21st. That's the next release date for the April CPI numbers. And ultimately, the Bank of Canada is meeting on June 5th. That gives them a little time to really digest that data. But this week, not only did we get the financial systems review by the Bank of Canada, which outlines some of the vulnerabilities, some of the problems that the Bank of Canada sees, not only when it comes to obviously interest rates and housing and the economy, but more importantly, productivity, what is happening right here at home. And as we continue to see these economic indicators worsen, well, the Bank of Canada really has a tall task in front of them. Do they get into ahead of this? They get proactive and say, hey, we need to really address this before it even gets worse? Or do they focus on basically holding the line, making sure that inflation is dead and gone? And ultimately, this is the balancing act. This is the conversation that the governor of the Bank of Canada was sort of asked at a most recent committee hearing by members of parliament. And we're going to look at some of those options, have that conversation this week. We'll clip into some of these conversation points. And I really think it's important for Canadians to understand what it is that the governor of the Bank of Canada is saying, because ultimately I think the tone does change a little bit when they do these press conferences to when they're actually being posed these questions at committee hearings. More Canadians are really focused on those headlines, but we're not getting a lot of that data. And I think when we look at the data, we have to look at different components. So what are we looking at when we talk about that data? Well, we've talked about on the channel, we've talked about productivity, right? Emergency levels. Canada is just not producing the infrastructure, the jobs, the environment that businesses need to grow. And ultimately, that is putting most Canadians at a significant disadvantage in comparison to our U.S. counterparts. So that's number one. Number two, we have insolvencies in businesses, retail spending coming down. We have many things that Canada is, in first place for, but not for the right reasons. Like our unemployment rate continues to worsen in comparison to other countries. So these are many economic indicators that the Bank of Canada really has to pay close attention to. Because remember, yes, the Bank of Canada has a job. Their job is to ensure that inflation is remaining level at around that 2% mark, the bandwidth between 1 and 3. And they do understand that that headline inflation number can bounce around a little bit. But ultimately, what they're saying is that there is a significant amount of downward pressure. They're starting to see the things that they want to see, especially when we look back at the January announcement, where they were then and where we are now. I think this is something that the governor of the Bank of Canada really pointed to. Here's what he had to say.
So at our last meeting a couple of weeks ago, we did discuss when it would be appropriate to reduce our policy interest rate. And as I outlined in the opening statement, we were certainly encouraged by the progress. We do see renewed downward momentum in underlying inflation. For a while, it had kind of stalled. We do see renewed downward momentum. And if you go back to what we said in January and March, we indicated then we were looking for further and sustained easing in underlying inflation. And what we concluded a couple of weeks ago was that we have seen further easing. What we're really looking for now is for assurance that that is sustained.
You talk about, when you say you're looking for signs that inflation is sustainably coming down before lowering interest rates, can you talk about what kinds of things you're looking at? Like, what are the kinds of things that Canadians, like my constituents in Etobicoke Centre, should be looking at to believe that things are heading in the right direction or not heading in the right direction? Because ultimately, they want to see you lower rates.
Yeah, it's a very good question. And so the first point is headline inflation, CPI inflation, is probably going, from month to month, it will bounce around. It's the latest reading is 2.9%. It probably will stay pretty close to that, around 3% for the next several months, because we know global oil prices went up. We know gasoline prices have gone up. And that has a very immediate effect on CPI. What we're looking for is when you strip out that, we want to see our measures of core or underlying inflation continue to move down. And so, watch CPI trim, watch CPI median. Those are our two preferred measures of core. In practice, those are our preferred measures for core for good reason, but we also look, there are other measures of underlying inflation, CPI-X food and energy, CPI-X, We also look at, in our monetary policy report, you'll see there's regularly a chart of the proportion of CPI components rising faster than 3%. When inflation was 8%, that was as high as 80%. The latest reading is 38%. Normal is about 25%. So we're getting down, we're not quite normal yet, but we're getting there. So what we're looking for, inflation to come down, for it to be less broad-based. We will be trying to look through the volatile components in headline. So try to focus on what we're focused on is the underlying measures.
So ultimately, yes, we do see that there is many indicators, those headline core medium and trim numbers, as the governor is pointing out. Those are the numbers that they really want to see come down in order for that door to swing wide open for them to sort of say, hey, we're ready to cut rates right now. But if we look at what other economists are saying, we're looking at someone like David Rosenberg. Whether you agree or disagree with some of his thoughts, he is a prolific financial mind here in Canada, and when he speaks, a lot of economists listen. And I bet you pretty much even the governor of the Bank of Canada has an ear to what these individuals are saying, because it's very important to understand what great minds have to say about the economy and what their governing council has to say. I mean, look, there's always that human element, that emotional part of it. And people like David Rosenberg are just arguing that, look, we understand there's a housing problem, right? Housing is a byproduct. If we lower interest rates, we understand that home prices tend to gradually increase.
The housing market is very sensitive to interest rates. And right now, the policy rate at 5% is restraining demand. It is making, obviously, the cost of a mortgage higher, restraining demand. If we lower interest rates, it will be less restrictive on housing, and other things equal, housing will tend to be stronger than it otherwise would have been. In our own forecast, we do have a pretty strong pickup in housing over the course of this year. We also have some increase in housing prices. We also expect that supply, while it isn't going to be able to grow quickly, we do expect supply will be growing gradually, and so the gap will be narrowing. But I would agree, it's definitely going to take some time to close that supply shortage.
That is, one problem of a multifaceted problem. What we're talking about is economic productivity. If the Bank of Canada doesn't start to pull rates back, we could be facing bigger problems. Deeper, longer recession, more Canadians unemployed, less business expenditures in Canada. These companies abroad need to come into Canada. And he's arguing that even if Canada does diverge, right? And this is something the governor of the Bank of Canada pointing to, this divergence between the Canadian and U.S. dollar. We've talked about on the channel before.
Yes, I think if we move lower than the Fed, that will tend to depreciate the Canadian dollar. That's partly how monetary policy works. A weaker dollar stimulates our exports, so monetary policy becomes less restrictive.
Ultimately, this is exactly what he's saying. If we're more competitive, if our dollar does weaken a little bit, then we might entice other businesses to actually maybe open up shop in Canada, right? Maybe build more in Canada to create more jobs and increase the productivity in Canada because our dollar is really attractive. Now, yes, we understand that if we increase the gap between the Canadian and U.S. dollar, well, because the U.S. is our biggest trading partner, that could import inflation. Of course, we understand that.
In Canada, obviously, we're very integrated with the United States, so the interest rates in the United States have an impact on us. Because we have our own currency, because we have a flexible exchange rate, we can run our own monetary policy, so our interest rates in Canada don't need to be the same as the U.S. rate or global rates. But there is a limit to how far they can diverge. We're not close to that limit. We have the ability to run our own monetary policy geared to what Canadians need.
They don't want to see that spread widen too much, okay? Because ultimately that could be bad. Now, it's happened in the 1990s and then again in the 2000s under the Mulroney and Chrétien government, where they had to diverge away from the U.S. in order to avoid major problems in Canada. So it has been done before. When those things happen, ultimately, what are the indicators that we can sort of look at? And one of those indicators is obviously unemployment, the economy as a whole. The Bank of Canada has a mandate to obviously, yes, tackle inflation, but it has to keep the Canadian economy afloat.
Thank you, Paul. Good morning. I'm very pleased to be here with Senior Deputy Governor Carolyn Rogers to discuss our financial stability report. Part of the bank's mandate is to preserve and promote the stability of the Canadian financial system. A stable and resilient financial system means people can access credit and manage their assets safely and predictably in good times and in bad. It also reduces the need for authorities to intervene in periods of financial stress. In short, a stable financial system is critical to Canada's economic well-being.
It has to think about the bigger picture. And if that means cutting interest rates is going to entice economic development, yes, spur spending, bring the economy back to life from this negative trajectory that it's on right now. Real story here is that Canada, if you strip away this, all this immigration, this human quantitative easing, right? Remember, more people in the economy consuming increases GDP, but our GDP per capita, the individual output of a Canadian, is worse than our counterparts in the U.S. So what does all that mean? Well, we want Canadians to be better off. We want Canadians to earn more money, even though it flies in the face of exactly what the Bank of Canada wants. They have this TSN turning point, as we call it, right? They have to make this decision. And I really think, based on the conversation, his comments, ultimately he's not going to come out, the governor of the Bank of Canada is not going to come out and say, yeah, we're cutting rates in June or we're going to cut rates in July. What they're saying is the data is telling us that, we're more comfortable to do that as we get this data, right? From January to now, we've seen CPI core medium and trim. These are the preferred measures of the Bank of Canada reducing, it's pulling back. Yes, we have higher oil prices. Yes, we have tensions in the Middle East. Yes, we have geopolitical problems, but in Canada, the economy is not performing. It's definitely not going to be a really good story if the Bank of Canada doesn't cut rates at some point. It's going to send the Canadian economy into a more severe recession. I believe we already are in one. You cannot walk around the streets of anywhere in at least Toronto, GTA, Vaughan, and not hear someone talking about either the current Liberal government or talking about the spending or talking about what they're feeling, their businesses, feeling the pressures of these higher interest rates. This is the major conversation. And when it gets to that level where everyone's talking about it, that means everyone's feeling it. And I think that's exactly what the Bank of Canada is really starting to get the picture.
As you know, and we've discussed at this committee before, folks are struggling for a range of reasons right now. Cost of living is high, housing prices are high, but there are a lot of folks who have mortgages that are either they're on a variable rate or they're on a fixed rate, and now they've had to renew at a much higher rate, and that's been very, very difficult for a lot of folks to bear, and some have had to move out of their homes. Some have had to make significant sacrifices to make those payments. So that's the underlying reason that I'm asking this question.
Well, I appreciate you sharing the concerns and the perspectives of your constituents. We also survey Canadians. We do hear directly from Canadians, and that is an important input into our monetary policy decisions.
Sure, right. I think they're really listening to the people on the streets. Yes, they have their surveys, their consumer surveys, and that's where they're pulling a lot of that data. We've talked about that before, but right now, if you listen to what the governor has to say around this particular measure, it's not looking too good. Before we end the video, I really just want to focus on one quick piece of information. I think a lot of Canadians understand that here in Canada, housing is a major component. It's a major driver of economic growth. Whether it's a productive growth or not, the question is jobs in the construction industry pay people's salaries, they pay people to spend in the economy, right? So if you see a business, a developer that's stopping to build, not building at all, construction's pulling back, the knock effect on that is much larger than we anticipate. They say that housing and housing related infrastructure is around 9% of GDP, but I think it's a lot greater. When you think about not just the development, the wood, the lumber, the contractors, but think about like everyone that does lawn care or does potentially furniture or anything to do with housing, the knock effect is massive here in Canada because we don't have that entrepreneurial spirit here in Canada. Most people work for a company. Most people are salaried employees by a company. A lot of people are not venturing off to open up their own businesses because the current climate in Canada doesn't allow that. And that's something also that David Rosenberg points out is that we're redistributing maybe the wealth within Canada rather than incentivizing people to go out there and start a business, or generate a business that can employ people, that can create more productive measures, tech, and benefit the Canadian economy. A lot of that's happening in the U.S. So, I mean, there's a lot to really unpack here, but what do you think is going to happen? You think the Bank of Canada is going to cut in June or July? What are your thoughts on the Canadian economy right now? Does the Bank of Canada need to cut rates sooner than later? Thanks again for watching. Thanks for stopping by. We'll see you next week.